Ladies and gentlemen, welcome back to part three, the final part of our three-part series of Capital Crest Financial Group presents a smarter way to protect through life insurance premium financing. Again, my name is Andrew Marin. It has been a pleasure learning with you and sharing life insurance premium financing in the hope that it may be able to assist your practice and your clients. Now let's jump right into it. Recall from last session, exit strategies. There are several trust-based options that we can explore. We can look at self-funding. We can look at an exit strategy of the cash surrender value of the policy or the death benefit from the passing of an insured. Now, income and estate planning, we're looking at ages of 18 to 55. Again, if we're looking at Gen 1, Gen 2 planning, or of course Gen 3 planning, we can look at younger ages. And for estate planning, typically between the ages of 55 and 89 for our clients. And identifying opportunities, determining a need. Is it age or is it estate-based need? Are we looking at business planning? And what do you do when you find a client? Well, request strategy sheets, much like the ones that we went over in part two, to really condense everything on one, hopefully easy to review strategy sheet so we can see how the lending and the insurance work together. We'll obtain approval from the carrier and the lender, and then follow what we call the steps, which we'll review momentarily. And who needs life insurance? Well, for estate planning. Premium finance life insurance can be used to reduce estate tax for uninsured or on young children and grandchildren, again, for the Gen 1 to 3 planning. It can be used for income replacement, to fund buy-sells, for key executives or employees. Nonprofit organizations can be used in a capital split dollar transaction. And how do I engage a client? Do you feel like you're paying too much for life insurance? Ask, how did you build your business? How did you purchase your home? Well, the answer is often going to be leverage. I leveraged a lender's capital at a small interest rate to reinvest and achieve my goals and to build my wealth. And the idea is putting somebody else's money to work for us. Again, our focus is shifting life insurance from a burdened need to a unique asset. Financing is a substitutive way to purchase life insurance in an attempt to maximize cash value growth, cash flow and gift tax efficiency, flexibility, and an increased IRR on death benefit and cash value, IRR being internal rate of return on the policy. And who can benefit? Again, we're looking for, as we coin, the healthy, the wealthy, and the wise. $5 million or greater net worth. Again, higher income earners or younger clients may qualify at a lower net worth. Up to age 89, the healthier the better. Income in excess of $200,000 annually. And again, pose the question, how are your clients paying? Can financing save them money? Can it increase their face amounts? Can it benefit them in one of those ways? And where to start? Well, start by looking at what you know, by your existing book of business. Look at annuity clients. Non-qualified annuities are a fantastic form of collateral to secure this premium financing transaction. Term policies can be converted and financed. Refinancing outside policy loans and outstanding policy loans. Increase existing policy face amounts and finance the difference. And recall, do you feel like you're paying too much for life insurance is a great way to start a conversation with a client. And remember, life insurance premium financing should never be the reason for entering into this transaction. Again, the need should already be there. Our goal is to give our clients options from which to choose the best fit for their plan. Now we're going to look at a few different audiences here, first being business owners, the opportunities to fund a cross-purchase buy-sell. Self-funded agreements can be very costly and take away from business cash flow. Key man policies and golden handcuffs, potential for interest deduction from the proceeds being contributed to the policy. I know we do not give tax advice, but certainly can be consulted for something along those lines, whether outside advice or certainly your individual attorney. And then we can also use a letter of credit as collateral. That is a great way to manifest or procure the funds to get this entire policy in place. And physicians are fantastic proponents for life insurance premium financing. Frequently encountered characteristics are strong cash flow but heavy debt or a heavy overhead. They may qualify at a net worth below $5 million. And they can also qualify if they're part of a group practice and the practice has a valuation north of $5 million. The opportunities here are supercharged retirement plans, living benefits including critical and terminal illness, golden handcuffs for medical staff or hospital healthcare group physicians. Estate liquidity. Opportunities are an irrevocable life insurance trust owned. The client contributes up to their gift tax amount annually. It reduces lifetime gift tax consequences, and we're typically looking at survivorship policies or certainly individual policies as well. Group premium financing is a fantastic way to implement this into your practice. The opportunities are key man insurance and golden handcuffs. The policies are portable, meaning that once a client is fully vested, they can take the policy with them in life. The policies have living benefits. We can utilize a domestic asset protection trust to house this entire transaction. The interest can be serviced by the employer or bonused to the employee. There is an option to defer interest entirely in some cases where it makes sense. We can set this to a desired vesting schedule, whether it's 5 years or 10 years, so the client has to become fully vested until they're able to get access to the cash in the account and the death benefit proceeds. And this can be used to augment or replace entirely an existing employee benefits program, again, because of the death benefit it provides, the cash accumulation that can be accessed, as well as the living benefits. International clients. Application and exams need to be completed in the States. The insured does not need direct U.S. ties. They must hold the collateral in a U.S. onshore bank, and the insurance amount depends on the country risk rating, as it is coined, but this is a fantastic way to assist international clients in the exact same structure and benefits that life insurance premium finance can bring. And annual renewals, what does that mean? Well, it means that we're perfecting the collateral for the coming year. This needs to be done until the policy's cash value is greater than the outstanding loan balance. Once that occurs, the policy is acting as primary and full collateral for that loan. So we re-examine the client profile and the insurance need. We revisit client cash flow for optimal interest contribution, analyze loan and policy performance each and every year, explore new funding strategies and loan designs. We can assess the index allocations at any point throughout the year if we're looking at an index policy. Obviously, for whole life, we do not have that same circumstance. And at the end of the term, we can evaluate renewal or refinance the loan. Considerations to bank financing to keep in mind is there is an interest rate risk. There is a crediting rate risk. The possibility of the loan not being renewed. Clients need to understand and be comfortable with the fact that there are several moving factors and moving pieces to this transaction. This is not a set it and forget it deal. And to mitigate the risks, options and flexibility are an absolute must. And that's where we can come in and really provide that back office support in addressing each and every one of these. Again, our job is to show the benefits and mitigate the risks of bank financing, to show the option of traditional funding against premium financing and which one makes sense, the most sense for our clients. In other firms, challenges on which we can capitalize, we do not do any short-term life settlements. We do not sell loans. There's a lack of team-based solutions and accountability out there, lack of uniform strategy and product delivery. Bank and lending rate options are something that we have in excess. We have several carriers and products that we can explore to find the best fit for our clients. There's an inconsistent crediting structure, inflexible loan documentation, substandard service and administrative support, and then the option or the possibility of fragmentation. And these are things that our specialists and our back office, really home office feel, have that we can really maximize on and make sure that we're providing a white glove treatment and just the best level of service and care for each one of our clients and our agents. In looking to the future, items worth discussing are interest rate risk for increasing interest rates, hedging against rising interest rate environment, loan portfolio review, maximizing policy output, possible refinancing at any given year, and an additional insurance need. Of course, most high net worth clients' estates grow. So too does their need for that insurance. And each one of these we can visit at any time throughout the process. And how to engage. Here are the steps. Determine a need for your client. Are they a viable candidate for life insurance premium financing? Would it make sense for them to finance those premiums instead of servicing them in full out of pocket? Submit a trial application. We have material that we can send over that really simplifies this, and we're able to take that intake form or trial application and we can see which box it will fit in and which carrier and lender may have an interest or provide the most competitive rates or terms. Then we'll we'll request strategy sheets and provide those strategy sheets, something similar to what we reviewed in part 2. Then we'll submit the insurance and financing applications and go through the underwriting process. The insurance and financing approval will come back. Then we'll have our trust documentations drafted. Again, our attorney can assist with that process in consulting with their attorneys, or we can do it all in-house. The collateral is perfected and assigned, and then the policy is funded. And that is basically top to bottom the steps of what we're looking at. Time frame could be anywhere from 2 months out to several months, depending on how many parties are involved, how accessible the information is that we need for underwriting, etc. Again, this is a disclosure. I want to thank you very much and sincerely for being here with us on this 3-part series. I hope that it has opened your eyes to the potential for premium financing, whether this is the first time you've heard about it or you have been doing it for years. We hope that this has opened some door or avenue for premium financing. Again, my name is Andrew Marin, and I want to thank you very much for being here with us. Now, our interactive questions and answers portion here, what I would like to do, if you'll permit me, is go through just a few of these questions that we get on a regular basis, and then we can open up the floor for anything else that you may have that we would like to address. And the first would be, why haven't I heard of this before? And that's a very common question that we're asked not only by the agents, but also by the clients. And there are several reasons. I'll just hit on the main very briefly, the main reasons. And number one is people don't want everybody to know about this. So a few reasons for that is, one, not everybody can qualify. This is really for that 1% of the population. So they're not going to have everybody out there looking for these life insurance premium finance candidates, and certainly don't want to distract agents from being out there and capitalizing on their bread and butter type policies, such as term policies, GULs, whole life policies, things of the sort. As far as policy ownership goes, that's going to be entirely dependent on the structure, on what is the nature and the purpose of these policies, what goals are we trying to accomplish. The most common strategy is going to be owned by an irrevocable life insurance trust or an ILIT that protects from creditor and predator protection, provides protection for that, and it can also be owned personally. It can be owned by a business. There are many variations on that, but certainly the most common is going to be ownership by an ILET. And loan responsibility comes down to the guarantor, whether that's the insured, whether it's a business, whether it's a third party. There's always going to be, again, the need for that collateral at the outset if we're looking at traditional premium financing. So loan responsibility is going to be the guarantor, whomever that person is or entity is. And once the policy, again, is in excess of the outstanding loan balance and the collateral disappears, this thing is basically set up to keep moving forward so long the interest is still being serviced and things of that sort. So it really just depends on, again, what the nature of the policy is and what goals we're trying to accomplish. As far as the accuracy of the projections, now nobody has a crystal ball. Nobody knows what the future is going to hold. We can only look at the past. And in the past, we can look at what the S&P has done, we can look at what LIBOR rates have done, and then we can look at the historical rate of return for these indexed universal life policies. And so we take those averages and we try to put them together and then go even below that average. So we're really projecting as conservative as possible. The only guarantee in any one of these is that the strategy sheet will not look that way in reality. That's just a projection, just kind of a benchmark to look at for a conceptual overview, again, of what we're trying to accomplish. There are no limits to contribution to the plan. Anything above the interest being serviced will go to principal reduction on that, so it provides flexibility to the client and provides the option to fund more should they choose to do so. For groups, do we have to implement the plan to everybody? And the answer is no. Depending certainly on what sort of company, what the purpose is, again, they can discriminate. And what I mean by that is just putting it on their key executives or just on their individuals making a certain amount of money. Again, it's going to depend on if we're looking at fully underwriting each participant, or if we're looking at a guaranteed or simplified issue plan, but there is the option just to carve out the key individuals or key persons in that particular business. As far as plan implementation and the duration of that, again, we touched on that briefly, but we can look as early as just over 2 months from start to finish, from the time the client says yes until the policies are funded and in force, up to several months to a year if we're working on a very large, complicated case. When there's more moving parts, of course, that just translates into a longer time frame. And if a client has existing insurance, can we convert or increase it and then finance that? And the answer is absolutely yes. We are able to convert term policies when available, and we can finance the difference there. Or we can look at a 1035 exchange if it makes sense, or keep the existing insurance policy and get a new insurance policy. And then for that new insurance policy that we're going to be financing, the collateral, we can use the old insurance policy's cash as collateral for the new policy. So there are many ways to implement this, and the flexibility and the options that we have really make this such a powerful tool for clients who fit into this box. Now, I will certainly open the floor to other questions as they come in. And thank you again.